to actually break the economy to get inflation down to 2%. We could have what's often called the lost decade.
And the idea of stagflation and lower growth going forward, while most economies kind of wash out every 7 years, economic cycle goes from peak to recession. If inflation's really bad and the Fed has to take rates much higher, it's going to...
In conversation number one today, we talked about the Fed perhaps having to actually break the economy to get inflation down to 2%. I want to kind of build on that conversation because right at the end, Anna really got me thinking about what I've been believing, but I want to put into words today. And that is, we could have what's often called the lost decade, where we just basically go sideways. And I think that's a conversation we need to have, Anna. What do you think?
Absolutely. And, we've been talking about this possibility for about a year as well. If you go back and listen to our shows about, what could happen and the idea of stagflation and lower growth going forward. And, I will say that I listen to a lot of gray-haired guys because they've been through many different cycles and they have a lot of wisdom to share. And what's interesting is a lot of people will say, hey, these guys are perma bears. They're always thinking it's going to get worse. But the reality is they've lived through ups and downs and they've seen the signs and they've seen that while most economies kind of wash out every 7 years, like an average economic cycle goes from peak to recession every 5.5 to 7 years, they're like, the reason it's been extended so long is because of these unnatural, not market forces, but the Fed's quantitative easing. And because of that easing, it's created this huge run of expansion, reliant upon cheap debt that's pushed asset values high, corporate profits high, but it's all artificial. And they've basically said, if inflation's really bad and the Fed has to take rates much higher, it's going to really squeeze profits because the debt payments required to service that debt, whether you're a commercial real estate owner, whether you're a small business owner or a large corporation that relies on low interest rate loans, especially interest only, that can just be refinanced and rolled over and over and over again. When that easy money lets off, that they now have a significant jump in their interest payments. And that alone could squeeze corporate profits by 50%. And so, basically, because of these conditions and having higher interest rates, it squeezes profitability and growth out of the system and basically redeploys money that would have gone to growing jobs, growing infrastructure, growing research and tech. And it says, now we don't have the money to do that because we have to put it toward debt. And so that is the big force that causes slow growth. And when you have inflation, higher costs of everything at the same time that you make debt more expensive, it just squeezes all the potential productive dollars out of the economy and puts them to, inflation and basically wage inflation and debt payments, and it causes very, very low growth. And we've seen this historically over and over again, but these gray hair guys like Buffett, like Jeremy Grantham, there's a bunch of others, Jim Ricards, they basically say, we think, Ray Dalio, we're going to have a lost decade. All of them are saying over the next 10 years, expect pockets of growth, and you're going to have to pick very carefully where you go to try to create returns. But putting your money in the stock market in an index fund and thinking you're going to get, something over the treasury is going to be really, really difficult. Parking it in commercial real estate at 3, 4, 5 caps is going to be really, really difficult. And you're going to have to work harder to create returns over the next decade, quite frankly, than you did over the last.
Yeah, I think, I certainly see a troubled 5-year period. I can get behind the kind of lost decade because I think what we're about to go through is an 18 to 24 month process of cleansing the system. There's a lot of leverage. There's a lot of zombie companies. There's a lot of people that should go bankrupt. There's a lot of financial engineers who were playing musical chairs and their chair's not there. That's going to take a while to wash out. So that gets me a couple of years from now, maybe 2025, maybe 2026.
Yes,
and then we're going to be in it.
Loans, Michael, just to interrupt real quick, most corporate loans and commercial real estate loans are coming due by 2026. And so that gets us 2024, 2025. In the commercial real estate sector alone, there's $1 trillion of commercial loans that are set to reset next year, another trillion the following, and then a little less than that in 2026. And that doesn't take into account corporate loans that also roll over. So I do think, people that think this is going to be really short and, during a recession, the next, 10 to 18 months for an average recession, that's just the beginning, because that causes more strain on those companies that have to reset their debt. But that pain isn't going to materialize until a couple of years after that.
So that's one step. I got more.
Yeah.
The next one I fear, and I can already see it happening in the residential market, is the commercial lenders, right? Regional banks that used to be just large lenders to kind of mom and pop businesses, small mom and pop builders, all of that. They're, for all intents and purposes, out of business. They're just trying to survive. They're just trying to survive. So,
yes. And can I add a little caveat to that too? A lot of people don't understand that. I have people ask me, well, why does what's happening in commercial real estate? So what? These people go under, they lose their money. They look at it as a rich man's problem. They say, why does that have to affect banks? The Fed will just bail them out. But the reality is most commercial real estate loans and corporate loans, I don't have the stat on corporate loans, but they're still very they're very mom and pop when it comes to small to medium sized businesses. They go to local to regional size lenders to get loans. And essentially these lenders hold on their books assets that are to us a mortgage. So you and I go out and we borrow for a commercial building, a small apartment, a small business, and our debt is now the bank's asset. And so the bank stays open basically by having greater assets than they do liabilities, just like any business. And so if we start to default on those loans, our default becomes them having to write down their assets. And so if regional banks have somewhere between 35 and 55% of corporate and commercial loans, which that's what the stats are depending on who you read, then that means that 35 to 55% or more have large assets that are dependent on us paying those mortgages. So if commercial real estate starts to fail, if small businesses start to fail, we see an uptick in bankruptcies every single month since at least this summer, and more are being announced every day. That is the banks having to write down their assets. And in previous recessions, Michael, interest rates during recession were slashed to record lows. And so typically, the banks at least held their consumer deposits, but the banks have this double whammy of having to write down their assets, and then they have depositors leaving for higher interest rate options like treasuries or bonds or something that they can open with their brokerage account. So they've got this double whammy that makes a bank very quickly insolvent on paper, having to raise more reserves than what they can, and if they can't, they fold. And this is, I'm not being a, doomer when I say this, but the reality is if you look at the run-up of interest rates and inflation in the 70s, what followed right after was a savings and loan crisis, because the asset bubble popped, the value of everything that was collateral went down, and those banks became insolvent. And we're seeing that already. The Fed and the Treasury have worked together for a stopgap for the top 3 banks that started to fail or that did fail earlier this year. But there is a huge potential fallout of this. And, going back to your point that that's the next domino, we could see many, many, many bank failures over the next few years. They'll get consolidated and we'll have fewer small banks and bigger large bank monopolies.
Yeah. And unfortunately, this has kind of a Texas two-step to it, because that's their existing portfolio. But where I see the real pain coming, and not that other's not real pain because it's nasty, but they also stop lending.
Yes.
That's the one that's going to...
Where do they make most of their money, Michael?
Lending.
On their lending. And they can't lend because they don't have the money to lend. They might have to hold more reserves because of what they think the fallout is going to be, and the, projections of the fallout of what type of loans they may have to take back. They can't afford to lend out the money. And, I work with a lot of different banks, small and large, depending on the type of asset. But I can tell you that part of the reason commercial real estate is coming to a halt is because the banks simply don't have the money to lend. They're saying your project is too big for us. And a lot of people don't realize that these banks, they don't lend their own money only. They go out and they syndicate the loans. So they go out and they say, hey, you other 2 or 3 banks, we have someone that wants $10 million. We can give them 2. Can you each give them 2 or 3? We'll pool that money together and we'll share the profits of the loan. Well, now all these banks are no longer being able to find the money partners to lend on big loans. And, so they can't. And that's where their profit margins are. So to your point, it's a double whammy Texas two-step, because they've got fleeing deposits, they've got assets they might have to write off, and they simply do not have the liquidity and the reserves to be comfortable to make loans. And this is before a recession has even started, Michael. And this is where, when people say, and I've read the comments and they're mostly really wonderful on the show, but you and I try to paint a realistic picture, not super sunshine and roses and not super doom and gloom. But the reality is we have a lot of pain coming. And when we say a lost decade, it's because of the reality and the breadth and the depth of this potential problem. When credit starts to squeeze, those who do have loans that think, well, okay, I may have to refinance them, but at least I can refinance them, from 4% over to 8%. They might not even be able to refinance them without putting cash into the table. So I can't even go to another lender and say, I have a problem with this loan. Will you refinance me out? They're going to go, we'll give you 55% LTV. And so there's a cash crunch, and that makes it really difficult for, businesses that employ people, by the way, commercial real estate, apartments that have tenants, et cetera. It makes it really difficult for them to survive a recession when lending dries up, and it's already happening beforehand. And so that, to me, is a picture of the future, that when a recession is here and is declared, that lending is just going to get tighter and tighter. So that's a next domino that kind of falls along that, let's say, 2 years for recession, another year for the commercial loans to fall, maybe another year for the banks to start to really, see some pain. I mean, that's 4 years in, and that's before a recovery, which usually takes another 2 to 3 years.
Yeah. Yeah, there's so much pain. And then kind of leaning over the last piece, I see this residential, right? Residential has a supply problem. I don't think that's a secret to anyone. But again, what people fail to realize is a lot of the construction industry is done by not the big boys. And I'm hearing from more and more builders that are just refusing to build.
Right.
And that's bad today. But what people don't get is you need to fast forward 6 months for when these units would have come on and realize that inventory won't be there. Right. So if we have more and more builders pulling back in late Q3, Q4, that means there's going to be a lot less inventory in the spring and summer. And I mean, what are we supposed to do? We're going to have high mortgage rates, no supply. People are going to be renting more. Back to your point, it's a vicious loop, right? If all these costs go up, it's got to be passed to somewhere. Rents go up again. We're just stuck in this loop.
Absolutely. Because here's the thing, and I work in commercial real estate in the multifamily side, and we had projects that we're ready to go on, that the fact that lenders have said, hey, when we got the land under contract and we had a 75 to 80% loan, and they told us 5%. But you have to go through zoning and approvals and all of that, which is harder and harder in many different areas. By the time that we got, ready to be able to close, I mean, we have rates that literally we're talking about complaining about, residential mortgages that are 7, try going to commercial development that are in the 9 to 10 to 11% range. And they've also cut you from 75 or 80% LTV, a lot of times down to about 55%. And that's for very experienced, well-capitalized developers. And it's because they're looking at your profits and they're saying, okay, even if we give you, 70% LTV, your debt payments aren't going to be covered by empty buildings that are not yet filled because you're still constructing. So you've got a couple of years of really negative cash flow while you're in the middle of the development process. But then they look at and project what it's going to be like in the future. And they say, insurance and taxes are going up 30, 40, 50% alone. The cost of your construction crew with wage demands is going up, and they just don't see how you can get to rents that cover the additional potential increases of costs, as well as rates that are higher for longer. So they're saying, in order for us to make sure that you have enough to just pay us, we're only giving you 55%. So what does that do to a developer? It takes my blended cost to construct from maybe, let's say 8%, 5% paid to the banks on 80% of my money, and let's say 20% paid to my investors on 20% of the money. It might be a blended rate in the 8% range, depending on how long I'm holding the deal, right? And how much profit I can make. But if I now I pay 10 or 11 on 55% of my money, and I got to pay 20% on 45% of my money, that's now a 15% cost of owning the deal. That may squeeze all the profits. You might be upside down on the project, and you go, wait, there's too much risk of unknown interest rates and
just too
costs.
hard. It's just too hard.
It's when I can go put my money in a treasury. And that's what banks are telling us is your return on this deal is less than if you didn't do the deal. So they're saying there's no risk premium for you as a builder on this deal. It makes it too risky for us as a lender to lend on. Because if that's your small profit margin and anything goes sideways, 4 or 5% profit can be wiped out very, very quickly with just one factor outside of, your control as a developer. And so developers are saying, you know what? I'm going to park my money in treasuries for a couple years, and we're going to wait and see. Once this corrects, we'll hold our land and we'll build when things get more attractive. So to your point, that constrains new supply. And there are many markets in the country that really, truly are undersupplied for housing. Others are oversupplied. But that means in those areas that are undersupplied, you will still have a lot of rental demand. You'll have less people able to buy a home. More people will have to rent. And that is actually going to drive up rents. And it's going to make, this inflationary problem on the housing side not go away.
Yeah. Well, you know what? We're gonna flip the script here. We're gonna end this one, episode 2. Episode 3 is all gonna be about where we see opportunity. These first 2 shows have kind of been a downer, but a downer. So I want to end strong with where you and I see opportunity, because where there's great pain, there's great opportunity. Anna, Where can people find you?
Great. You can find me here on your show every week on social media at Anna Kelly, REI Mom, and my website for coaching consulting is AnnaKellyInvesting.com.
Thank you so much.